One thing that all economists agree on in 2024 is that the risk will be elevated in the stock market.
We are starting to see some cracks in terms of the consumer spending, and the Fed is still in restrictive territory. I think that puts some headwinds on growth.
This will be the year of the landing, where we find out if Jerome Powell will crumble the economy or if he's going to have one of the biggest success stories in history. But economists also mention stagflation, economic slowdown, geopolitical and credit risk. The risk is so elevated that even the most bullish Wall Street analyst expects a pullback. So, is it time to sell your stocks? To find out, I studied what the major investment banks recommend to keep an eye on. And the most important risk is that of resurging inflation. And I know what you're thinking. Hey, that's so 2023, inflation is coming down fast. And that is true. Inflation is coming down, and the last read showed a price consumer index below expectations, but it is still at 3%, and economists warn that getting to the last stretch of inflation is the most difficult part. There are still factors that will keep inflation elevated.
I'm a little concerned that inflation won't prove as passive as the markets and maybe even some of the central bankers are thinking.
BNP Paribas argues that deglobalization, constrained labor markets, and investment in the green energy transition are all inflationary factors. There have been periods in history in the 1970s when inflation initially cooled off, which made Fed cut interest rates too quickly, and as a result, inflation reappeared stronger because of huge governmental spending. What followed was an aggressive series of rate hikes. Back then, Fed acted impulsively and this hurt the economy. Economists from Charles Schwab argue that less volatility and more stability in the interest rates would be favorable for the US stock market. So, when cutting interest rates, Fed will not act unless they're certain that they're making the right move. Next, the second risk, and this is a close second, is the risk of a recession triggered in the labor market. You see, the Fed has only two objectives.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
But since they're forced to reduce inflation, this will come at a cost. Because the only way to lower inflation is to slow the economy with high interest rates. And when the economy slows down, unemployment rises. But the good news is that there are still more job openings than unemployed workers. But JP Morgan estimates that this gap has shrunk from its peak of over 6 million to close to 2.5 million today. Now Fed expects the unemployment rate to slightly grow and estimates it will hit 4.1% at the end of this year from 3.8% at the end of 2023. But the risk is that the unemployment rate will surprise on the upside. This is the single most important indicator that will decide if a recession will materialize. As economists from Charles Schwab highlight, this is where the true effects of high interest rates will be visible. But to make things worse, Fed can't really know the exact unemployment rate at all times because the effects of high interest rates generally function with a lag.
The full effects of our tightening likely have not yet been felt.
So, Fed will have to keep rates elevated for just enough to lower inflation without destroying the labor market. What can I say, that's a tough job. Next, the third risk is basically what happens when the first two go badly. We might have a combination of sticky inflation, no economic growth, and high unemployment. These three create stagflation. Shades of stagflation can be seen in Europe. Economists from Deutsche Bank and BNP Paribas argue that Europe is in a mild recession that will continue into the first half of 2024. Moreover, Europe's unemployment rate is at 6.5% for the EU countries, much higher than the 3.8% in the US. And Europe's GDP is expected to grow 1.2% in 2024, slower than the US. This is mostly because of the biggest European economy, Germany, which has been in a manufacturing recession for the last 2 years. And to add salt to injury, after inflation came down to 2.4% in November, it resurged in December, coming in hot at 2.9%. This is definitely unexpected, as it makes the stagflation scenario real. As of right now, stagflation does not seem probable in the US, but it will definitely be something that the Fed will keep a close eye on. The fourth risk comes from the credit market, where there's a lot of pressure building. That's what happens when you have interest rates rising at the fastest pace in history. And it's obvious by the increasing number of people falling behind on their payments. This applies to people using credit cards, student loans, or car payments. JP Morgan estimates that vulnerable sectors are commercial real estate, leveraged loans, and some areas of consumer credit, for instance auto and credit cards. So, stocks like Tesla or Rivian might be affected the longer the interest rates remain elevated. JP Morgan also warns that small caps will be affected, more precisely the ones with high debt on their balance sheets. Moreover, JP Morgan argues that regional banks remain under pressure since these are earning low rates on all loans while having to pay higher and higher rates to attract deposits. So, the scenarios that we've seen with the collapse of Silicon Valley Bank can be replicated in 2024. Still, as of now, the credit risk doesn't seem enough to cause a recession. Real recessions reflect contagion and typically they need a catalyst, either in the labor market or in the financial system. Next, let's get into the risks related strictly to the stock market. And here's where things get interesting, because firstly, the market expects that Fed will be cutting rates in March. The futures market gives a 66% probability that the first rate cut comes in March. Moreover, it has a 52% probability of 2 rate cuts happening by May 1st. Morgan Stanley warns that stocks typically begin to sell off 3 months before a new round of monetary easing, as risk assets start anticipating slower growth. However, economists from Charles Schwab warn that if Fed cuts rates before June 2024, it's because of deterioration in the economy, more specifically in the labor market. Of course, the best scenario is that where inflation continues to drop and it gets even close to 2%, but if not, 2 rate cuts by May show that something is off in the economy. But on the other hand, data from FactSet shows that the market anticipates a 2024 EPS growth of 11% for the companies in the S&P 500. Now, an 11% growth fits the soft landing scenario, but economists from BNP Paribas argue that risks are easily skewed towards weaker growth. This scenario would lead to lower equity prices as expected earnings fail to materialize. To sum up, it seems like the market is too optimistic, and all these expectations are priced into the valuation. Right now, the companies in the S&P 500 trade at a forward PE of 19.2 times, which is above the 5 and the 10-year averages. So, it is obvious that if these companies will grow lower than expected, the multiples will drop and the stock prices will fall. Moreover, another risk related to the stock market comes from the market breadth. In 2023, when 70% of economists were predicting a recession, the S&P 500 grew an impressive 25%, and that's only because of the Magnificent 7, but without these 7 stocks, the return would have been of only 10%. In November, the top 10 stocks weighted 32% of S&P 500. This is extreme concentration, and Goldman shows that it's never been this high. And although these companies grew faster than expected and have high margins, good reinvestment ratios, and strong balance sheets, the concentration is not healthy. Economists from Charles Schwab estimate that the greater the number of stocks that are helping push the market higher, the more support the market has. So, should you sell all your stocks and wait for the pullback? Well, not really, because 2024 might still provide positive returns. Tom Lee, the most bullish analyst on Wall Street and one of the few people that were bullish in 2023, expects a pullback of 5% in the first quarter, as he believes that the Fed will not lower interest rates as quickly as March. Moreover, after the strong 2023 performance, the market needs to consolidate from a technical perspective, and lastly, a drawdown in February or March is consistent with returns from election years. Election years have generally been fruitful for the stock market. Lastly, Goldman, Citibank, and JP Morgan all acknowledge that the first half of the year will be volatile, but they recommend to stay invested in equities as many asset classes will recover. To sum up, the key to the performance of the stock market will be on how the economy reacts to the lagged effects of high interest rates. Most of the economists argue that the first half of the year will be difficult. The stock market has priced in high expectations, and this is generally a setup for a short-term correction. Stocks typically drop 3 months before a rate cut. However, experts don't recommend to exit the market, but it would probably be wise to have some cash ready to deploy in your highest conviction names. So, keep a close eye on these factors, or if you don't have the time to do it, subscribe to the channel and I might keep you posted.